Welcome to IFRS Talks, your source for all things IFRS. I'm your host, Laura Kennedy, and today we're saying hello to a brand new accounting standard, IFRS 18, on presentation and disclosure in the financial statements. To take a look at this exciting new standard, I have the pleasure of being joined by Nick Barlow from the IASB technical staff and our very own IFRS Talks regular, Gary Berkowitz.
Hi Nick, hi Gary, welcome on to IFRS Talks. Nick, thank you for joining us here at PwC. It's your first time on IFRS Talks. Can I ask you to introduce yourself?
Of course, thanks for having me. My name is Nick Barlow. I'm a member of the IASB technical staff, and I work on what was the primary financial statements project, now IFRS 18. I've been working on that for the last 5.5 years.
Fantastic. And Gary, you're a regular. You don't usually introduce yourself, but I don't want you to feel left out, so maybe I'll ask you as well.
Thanks, Laura. Thank you. So I'm obviously at PwC with you, Laura, and part of my job is following some of the IASB board projects, one of them being IFRS 18. So that's why I guess I'm here. So it's nice to have Nick in the room. Hey, Nick.
Hello.
Nick, your colleague Craig, was here last month talking to us about the business combinations exposure draft that they got out. And the first question I asked him was how they celebrated getting their exposure draft out. You've just got out a final standard, so I have to ask as well, how did the team celebrate?
We had a bit of a celebration in the office, nothing too extravagant. A few beers were drank, a few songs were sung, but that was it, a little bit low-key.
Low-key sounds great. All right then, so IFRS 18 came out on the 9th of April. It's going to be effective in 2027. It's the first new standard to come out for 7 years. There were a lot of standards that came out previously. We had 9, we had 16, 15, 17. And then we kind of felt like there was this period of calm while people were coping with those standards, getting used to them. IFRS 18 is presentation and disclosure in the financial statements. It's replacing IAS 1. Tell us a bit about the project and sort of why IFRS 18? Why is this the right new standard now?
Sure. So as you may well know, the project really came out from stakeholder feedback and in particular investor feedback. And they really pointed to a few key things that they've been looking at for many years. And one of those was around presentation, particularly around performance and getting better communication around how an entity communicates that performance in the financial statements. So the project really tackled that first as a bit of a corollary to that in thinking about how to address performance reporting more generally. The idea was introduced around, well, how do we get entity-specific information? And so the project talks and has requirements around what we call in the project management defined performance measures, but really things that people know today as APMs or non-GAAP. And those ones specifically that are focused around that performance reporting and the statement of profit or loss. And then the other main aspect that investors said they wanted better information about was around disaggregation. And not necessarily a more is better approach. It was more about how do we get the right information? Sometimes we get very detailed information, but about things that are less important. And sometimes things are so aggregated, it's very difficult to pull out the important information. And so IFRS 18 sort of tries to tackle each of these elements from different angles.
And Gary, from your perspective, what are you excited about with IFRS 18?
Well, actually, it's interesting. The thing I'm probably excited about the most is I think when we've chatted to people, their excitement is probably around what Nick described as the MPM section. A lot of preparers excited about finally bringing some non-GAAP stuff into the financials. But personally, I think the thing I'm most excited about is actually what Nick described as the aggregation and disaggregation requirements. Because again, even from, I guess, our perspective, it's been challenging in the past because IAS 1 had very limited guidance on when you aggregate or disaggregate information. I think IFRS 18 has a fair amount more in terms of the principle and factors to consider. And so I'm hoping that people really do take the opportunity to reconsider the way they've aggregated and disaggregated things in the primaries and in the notes. I think that's a sleeper issue, which not everyone is potentially really focusing on at the moment, but I think that's going to be quite a big one moving forward. And I think what's also maybe just important there is that, as Nick said, the majority of the changes are around statement of performance or income statement, whereas aggregation and disaggregation is one of the key things, I think, at least, that applies to balance sheet or statement of financial position. I'm old school, so balance sheet and income statement, but that applies to all your primaries. So I think it's one to really watch out for.
Okay, so moving on then to maybe if we go through each of the things you mentioned, Nick, let's start with the subtotals. So with subtotals for profit or loss, I saw that there are three main categories under IFRS 18. So there's operating category, investing category, financing category. Can you tell us a bit more about those requirements, those categories? And maybe, I guess to me, initially it sounded simple, but when you think about all the transactions that businesses have, they're very complex. So putting everything into three buckets, there probably is some judgment there. So I'd be interested to hear what you think about that.
Certainly. So a couple of questions there. So first, the requirements themselves. So you're right, the requirements set out the format of the statement of profit or loss to have three main categories. Operating, the idea being to capture a more holistic view of the entity's operation. So it ends up being a default, picking up all of income and expenses that are not classified in the other categories. Then there's an investing category, which captures those things that investors told us they like to pull out and separate and analyze separately from the operations of the entity. And then lastly, a financing category, which obviously is how the entity finances those operations. And sort of intersecting those individual categories are two required subtotals that we defined and that all entities will be required to present, giving more comparability across. And so the obvious one, operating profit, which gives that complete picture again, and then the profit before financing and income tax, the idea being to give a measure that's independent of how an entity is financed, and again, giving that comparability from entity to entity. So then the other bit you asked was about, let's say, my words, not yours, but complexity. And it's one that I think I've heard a few times and is maybe a little bit unfair. I think I would reterm it in other ways. We've benefited a lot from stakeholder input throughout this project. And when I think about when we came up with the requirements or we're working on the requirements, we had to touch on every standard almost within the suite of IFRS standards. And each one of those was created at a time where we didn't have the structure in the statement of profit or loss. So we sort of kept coming up around these questions about, okay, well, what do you do with this particular type of income and expense, or what do you do with that one? And foreign exchange is a perfect example. Early on, we had a company try out our proposed structure, and they came back and said, as you suggested, sort of easy enough. But what do I do with FX? If I have it on financing, it could be financing. If I have it on in something in investing, it could be investing. What am I meant to do with this? And so that led to specific requirements, which say just that, to have the income and expenses follow similar income and expenses from where that foreign exchange is coming from. And so that's just one example. I mean, we have things around hedge accounting. We have things on liabilities that are hybrid instruments. And I think there's guidance all there, but there's lots of things that companies are going to need to think about in terms of when I get down to classifying. Yes, it sounds simple, but simple isn't always easy.
Yeah, and if I can maybe just jump in there, because I do think, Nick, as you mentioned before, the board's objective here was to drive more comparability in reporting. But in order to do that, you need to often give people more guidance in order to help them decide
Absolutely.
How they should put things in the income statement. And I think then if you do actually kind of look at the words, it is far more complicated than if you look at IS1 today. I think, to be fair, the actual, the number of paragraphs and the words, but I think that reflects exactly what you were pointing out, Nick, which is, to drive that comparability, consistency, giving people the detail they need on things that they didn't have before, you're going to need more words. And although in a first read, when we read it, we were like, wow, this is a lot harder than IS1. That's to be expected. And I think some of that is because it's new. So things are always hard when they're new. But I think the other thing is the point that Nick made, which is, I think, to be fair, that the board and the staff were really trying to give people the information they needed for as many different types of scenarios they could see. And we could see, as you guys were working on the project, more stuff got added in as you were obviously getting feedback from preparers who were trying to actually use the stuff. So things like Forex, things like hedging. And I think the other key aspect is that this is a standard that's intended to deal with all types of entities. So, my background is generally corporates, making widgets, hard stuff, tech, or things like that.
I was going to ask about it.
There you go. But I mean, obviously we've got to deal with banks and we've got to deal with insurance companies as well. And this is a one standard that does everything. And so I think, again, a lot of the what we call complexity, but maybe Nick would rephrase that as helpful guidance in the standard, is to really help you ensure that regardless of the type of business you have, you'll get the right things into the right category. And I don't know, Nick, if you want to spend a bit of time just explaining to folks how will I apply this if I'm a bank versus, for example,
Yeah, no, that's right. And I was going to jump right in and say exactly that. That's the perfect example. I mean, when we're trying to get that operating profit that's comparable across entities, you sort of immediately run up with this. Well, if financing, which was going into a financing category as my business, how am I actually showing my operations? And so there are requirements then in the standard. We talked about what we call this in the standard, your main business activities. But really the idea is about being able to show what those key operating metrics of performance are and making sure that they arrive in that operating profit to make that comparable across these different types of entities. And so there's specific requirements for those entities that would have a main business activity of financing or investing. They're able to move some specific income and expenses into operating to be able to draw those subtotals and make it make sense when you compare across.
And I guess, again, maybe one last observation from my side. I think there is still going to be a fair bit of work to be done in terms of, as we digest the words, but also judgment applied for some entities in some cases to work out when you have a main business activity of investing or financing. Sometimes when you just use the basic example of retail bank, pretty easy, widget maker, pretty easy, but I think there are going to be some in between those two where making that judgment is going to be more challenging. Yeah. So I'd say don't underestimate that to the extent you've got a complex business that does more than one main activity.
Yeah, no, and I think that's right. And we call them conglomerates. I think you're right. If you're a bank, you're a bank. If you're a real estate investor, you're a real estate investor. It's those ones on the margins where you may have, investing and financing and other things, and how you bring these all together. There's certainly some judgment to be made in those sort of side cases.
Changing lanes then, Nick, onto one of the other things you mentioned. You mentioned the new disclosure requirements are going to be there for management performance measures. So I guess question from me is, what are those requirements? But also there are so many different, at least I would call them alternative performance measures or APMs out there. Which ones are in scope of these requirements? And also, what does that mean not only for companies, but for auditors?
Sure. So our management defined performance measures, as I mentioned before, really came out of this idea of focusing on the statement of performance. So there is a specific definition. It's relatively narrow. It's because it's the subtotals of income and expenses. So again, providing that tie-in to the performance reporting. It's those measures that are communicated publicly outside the financial statements. So the idea being to capture things that are already reported, not trying to define another subset of information or create another subset of information out there. And then importantly, it's about communicating management's view of the performance, because that was really the goal that investors said, this is the information that's useful to them. And so that's built right into the definition. Now it's a subset of, as you say, what we might know today as APMs or non-GAAP information. And I think it's worth remembering that this is quite new to bring it into the financial statements, but bringing what has been typically in the view of external communications like the management commentary was quite a new idea, and one that not everyone was comfortable with, at least at first. And certainly during the exposure draft, there was quite a lot of concerns about what was put out there. But then interestingly, when we got the feedback on the exposure draft, there was a bit of a turn in let's say, public opinion. There was a lot of feedback that came back that said, this is bringing transparency to these types of measures is great. Wouldn't the same thing be great for other measures, like based on the balance sheet or the cash flow statement? And so it was something that the board debated at some length, but ultimately decided there was equally feedback saying, we want this project done as quickly as possible. Let's move the ball forward. And so there was sort of a mission focus on, okay, let's get this done with performance reporting and not spend the time necessary to make something that's going to work for those other statements, which was just going to delay the project as a whole.
Yeah, and that makes sense. You never know. First step.
We hope.
And I mean, I think it's I think our public comment. I think we, once we thought about it, we were part of the group. I think that felt from a relevance of financial statements perspective and relevance of kind of what the IASB and what we as auditors do. We felt that investors, the customers, actually asking for this information will make sense to provide it. So I think we were more supportive of expanding the scope. And as Laura said, maybe one day, once we've got 18, it's issued and whatever, and we've got time to reflect on how it's going, maybe we'll expand the number of APMs that come into MPMs. Because I think, Nick, as you're saying, some of the reason was investors said, well, there's all this information, we want a bit of rigor around, and once it comes into the financials, it obviously becomes subject to audit, subject to processes, and I think then it's important for folks to maybe understand once something is deemed to be an MPM, let's assume you meet the definition, I think just clarifying, then you're required in a single note to describe these are all of the management performance measures that relate to the income statements. I need to reconcile them to their closest IFRS number. I need to explain why it provides a view of the business. So I think it really does, hopefully will provide more useful and fulsome information to investors, at least for that subcategory that relate to the income statement.
No, that's right. And I think a big benefit of it is getting that same consistency of the set of information that's disclosed across all of the IFRS jurisdictions. In some jurisdictions, what you've just described as the disclosure requirements are probably very familiar for those somewhere like the UK or Europe where there are guidelines. And for the most part, they're very similar. It's making sure that exists for all of the management performance measures that are within the set and across jurisdictions. So I think there's a bit of comparability across that helps as well.
So can I ask Nick a cheeky question? And so I think I know the answer to this one, but let me check. So EBITDA. So is that going to become a management performance measure now under the new requirements or not?
Well, it's a bit of a depends answer. So this is, as I'm sure you're aware, something that the board also debated at some length about EBITDA. Ultimately, in the standard, they've defined a measure that's like EBITDA, as we understand many define EBITDA. So it's operating profit before depreciation and amortization and impairments. And so the standard specifically says if that's how you calculate it, then it's not a management-defined performance measure. It's really just made up of elements of the statement of profit or loss that we can see and are sort of added or subtracted. So that's not a management-defined performance measure. Now, we also know that there's not one way to calculate EBITDA, and that was part of what management-defined performance measures and the structure and statement of profit or loss we're trying to achieve. So if EBITDA is calculated in a different way, it would be a management-defined performance measure, but then you have this defined subtotal that you could reconcile back to.
Yeah. No, I think that's spot on. And I think again, great decision on the board on this, because again, we've seen in practice people will call things EBITDA, but we know that one company's EBITDA is not necessarily another company's EBITDA. You think it's the same acronym, but sometimes there'd be, our EBITDA, by the way, this is what we've called it, but it excludes share-based payments, for example. So I do think in many cases, I agree with you. It's good to see that I got the right answer, because but I think it will depend. But I think in many cases, companies will need to kind of have a look at how they've defined EBITDA, and I think they'll probably find that in many cases it's now going to fall into the definition of an MPM, which comes across with, as you mentioned, a couple of other requirements and disclosure requirements. So watch that one, yeah.
If they keep it, that is. When we've got the new IFRS 18 subtotals anyway.
Correct.
As we say, there's this newly defined similar measure of operating profit and depreciation and amortization that entities could sort of coalesce around and then get a bit of comparability in that individual measure.
Right, then moving on then to maybe the aggregation and disaggregation bit that Gary seemed very excited for. So Nick, you mentioned at the beginning, it's so hard to decide, to give the right amount of information about your transactions and what's been going on, but not give so much detail that you've got a 400-page annual report full of small details. So with that in mind, it's great that IFRS 18 is providing guidance to help on that. How have you gone about developing that? What kind of guidance is it providing?
So it comes at it from a few angles. And first, I'm glad that you're excited about it, because I think it is one that some IASB members will say it's sort of the hidden gem of the project. Because I think the subtotals gets all of the headlines, but there are some very helpful things, I think, within aggregation, disaggregation. As we say, we're sort of up against, it needs to interact with materiality, and that means it's going to be very, by nature, circumstance and entity specific. So there's sort of no one way to say, do this for materiality. And so the standard breaks it, comes at it sort of from three levels. Sort of from the highest level, we have a definition of the roles of the primary financial statements versus the notes. And while it's a relatively conceptual concept, which we call to provide a useful structured summary, being the objective of the primary financial statements, the key idea is really observing that materiality can't be the level of disaggregation or at the primary financial statement level. It would just result in too much detail to be understandable. Mm-hmm. So that is what's required in the notes to give the material information. And then so some higher level of aggregation is required. So there's sort of this high level distinction between the two. And then if we come down a level, there's specific guidance around how would you think about aggregation and disaggregation. And we base that around characteristics. And so they're not sort of a random set of characteristics. They're characteristics that have been collected that exist today throughout IFRS standards and been assigned to those that are relevant for the statement of profit or loss, those that are more applicable to the statement of financial position, and then given a bit of guidance around how you use those to then bring items together or to separate them. And then again, importantly saying, if one of those characteristics would result in material information, then you're required to disclose that material information. Along similar lines, we have some guidance around to be helpful to direct people how to come up with better labels, something, and again, based around those characteristics. So if you're aggregating on these characteristics, that's a basis for describing things in a way that's a bit more helpful. And then something specific around what are termed other, which investors found particularly unhelpful, particularly when it's a very large balance. And so some specific guidance around being more helpful there and giving more information when you have a large balance. It's called other.
That makes sense. I've seen other so many times.
other. Yeah. And so then the final level is some very directed and specific requirements around natures by item when an entity presents its operating expenses by function. And so there's a specific list of items, most of which or all of which are required today, but it requires a bit more detail around how those link back then to the line items in the statement of profit or loss.
So maybe I'll add as you're talking, three things. Let's see if I remember all of them by the end of what I said. I think that the first is just maybe there's a really good example that I think is either in the standard or the basis that really brings it to light to say, okay, so you may have, financial assets. Some are amortized costs, some are at fair value, and the fair value ones might be debt instruments that failed SPPI, and some might be kind of equities. And I think it says, when you apply all this guidance together, you might decide that for purposes of the balance sheet or statement of financial position, you should group those all together and say, these are my financial assets. Once I think about all the principles, they're all material, so yes, but it's the level of aggregation or disaggregation. But when I go to the notes, I might need to now provide more detail on that when I think about those characteristics to say, although they're all financial assets, they come from the same standard, their measurement bases are different. For example, some are at cost and some are at fair value, so you might want to disaggregate those two. But then even within the items that are at fair value, your equities versus your debt instruments, the risks related to those are different. And so those characteristics are really helpful. You might have to disaggregate even further and say within my financial instruments at fair value, here are the debt instruments versus the equities because the risk profile is different. So I think it's a really good example that kind of, I think, brings it to light in terms of how you apply all the different pieces together to decide where does it go, and then wherever it is, how much disaggregation do I have? And now I've forgotten the other 2 points. Except I remember the one, and then we'll leave the third one for us and a following podcast. I think the one was just also when you were mentioning the function and nature. I think what people will be interested in, which was a $1 million question, which then got answered by the board. Can I still mix function and nature? Because I think for a lot of time people would have, for example, an income statement that had cost of sales, but then they'd like to pull impairments out separately from cost of sales. Back under IS1, you said, well, that's really mixing function and nature. Over time, practice developed where we would accept it, but as auditors grudgingly, and we tried to steer people away from doing that. And I think the board got asked that specific question. I think it gets answered then in 18. Nick, I don't know if you want to hum a couple of bars on that one.
Yeah, no, definitely, because it was something that was debated and in fact ended up in a different place from what was exposed initially. Because I think, as you say, many looked at what was happening in practice under IS1 and would see disaggregation was our sort of classic example that you could have some of that allocated into cost of sales, for example, and then also a separate line item called depreciation. And it sort of begged the question, well, hang on a minute, how can you have this depreciation hanging and some of it's allocated? And so this was kind of the problem that was trying to be solved. And initially, the exposure draft proposed just a ban on doing this mixing of nature and function. But then
we as auditors started out big like, yay, finally we've got some guidance, but then I think you guys heard some feedback.
No, that's exactly it. Then we got feedback from users included that said, actually, in that case, we do see your point, but there's actually other disaggregations, as you alluded to, of pulling out an impairment, for example, that's helpful to see that as an individual line item. So the board took that into account. And so in the final standard, there is not a prohibition on mixing. It's about determining for that particular line item what's the best presentation.
And as you've been speaking, I've remembered my third and final point, which was just a quick one, which was to say, getting to this other, I think the point was just from a practical perspective. For folks that you said, Laura, who do have big balances of other, either be it kind of what probably you normally see it in the notes, you wouldn't see it in the primaries, hopefully. But in the notes, I think it's really, you need to build in a process before the effective date of IFRS 18 to really challenge yourself based on those new requirements to say, can you find items with the similar characteristics or similar characteristics that you can pull out and describe in a better way? If not, what are you going to do about it? Because I think the standard saying, even if you're going to call it other, you still need to describe that other in the most appropriate way. So it's other operating expenses or other something else. I think that if you have a big balance of other as part of this project, you really need to challenge yourself on, is that still appropriate when 18 comes out?
Yeah, and I think to be clear, no one's saying it's banned. We know that sometimes it's inevitable that you have some other, but it's about being more transparent about what is that, letting the user know how you've applied materiality to get there, and that there's something, there's nothing in here. It's a collection of immaterial balances, for example, that can't be better described. Simple as doing that may be enough to get you there.
Yeah.
Sounds like IFRS 18 is just a great opportunity to do a big spring clean.
Yeah,
absolutely.
Absolutely. Exactly. Well, it's about spring clean. I call it an opportunity to kind of dust stuff off and have another go at things that have just developed over practice. And this is your opportunity to say, is that still a right answer? Yeah.
No, absolutely.
So, Nick, we mentioned already it's going to be effective in 2027. It's going to come around quite fast. I know that when the IASB issues a standard, its work doesn't stop there. What are you guys doing? What are you producing for people that they can look to for help in terms of educational support, implementation support, and what's going to go on over the next few months?
Sure. So I think there's a number of things. First and foremost, I would direct people to the implementation support pages that we have and to our project page where we have the published documents. That's where you'll find all the information that's there and coming. In terms of what's there now, we have within the standard itself, or along with the standard itself, we have illustrative examples. Within those illustrative examples, we've worked to produce some flowcharts and decision trees, things to sort of pull apart. As Gary said, there's a lot of words, maybe compared to IAS 1. Those flowcharts try to help bring that home a little bit, make it a little bit easier to cut through and understand. There's also the effects analysis, which of course outlines what we expect the impacts to be. That will obviously inform people on what might be, how they might be impacted. And then for those looking at a more high level, we have this IFRS 18 on a page, high level review.
I like that. That IFRS 18 on one page is so much less complicated than IFRS 17 on one page.
Yeah. Fair enough. Alongside that, we are in the process of doing a number of outreach events in coordination with national standard setters and endorsement bodies around the globe. Here in the UK, we'll be working with the UK Endorsement Board and doing some events here. Those will be public, and we'll have the opportunity for people to ask questions directly. We'll also be doing our own webcasts, going sort of deeper dive into each of those three key areas that we talked about today. Again, giving people an opportunity to ask questions live and we'll be able to address those. And then, of course, we have the IFRS Foundation conference coming in June, and we'll have some dedicated sessions there.
So you're going to be busy, huh, Nick? So, yeah.
We'll be busy.
Yeah, from our side, obviously, we issued our in-brief a day or so after the standard got issued, and we're in the process of updating our guidance on viewpoint on what will effectively replace our current chapter on presentation and disclosure in the financials. So we'll incorporate all of the guidance on 18 into our own interpretations from a PwC perspective. But I think one thing I wanted to pick up there, Nick, I guess there's going to be a lot of support that comes along, obviously, from yourselves and ourselves and audit firms. I think 2027 seems like a long way away, but I think the requirement's quite important to remember. You need to restate your comparatives. So in a lot of time, this is going to impact charts of accounts, how things flow through systems, and as soon as systems and charts of accounts and process gets involved, you're going to need controls over it. So it seems like a long way away, but when you need to restate your comparatives, you probably want to have a good idea of what that's going to be before 2027. And I think another important point to make, and I know this got discussed at the board, Nick, as well, was just for some companies that may be foreign private issuers or voluntarily provide two sets of comparatives. If you think about it, that's 2026 is your first comparative, but 2025 will be your second if you provide two sets of comparatives, which is just around the corner.
Yeah.
And so I know, the board discussed whether or not they should provide some kind of specific exemption or allowance for folks if they were going to provide a second set of comparatives. And I think, Nick, correct me, but I think they ultimately decided they weren't going to put anything in on any kind of special exemption. And so that means if you are going to provide 2 years of comparatives, they're going to need to be IFRS 18 comparatives to align with a full set of IFRS.
That makes sense. It would be quite hard to, because of what it is in terms of the presentation in the P&L, it'd be very hard to have one on a different basis.
Yes, I think I got to the right answer, but it just shows you that people were saying, clearly you can provide some colour commentary, but that wouldn't have come out of nowhere. Clearly there were some stakeholders that were saying, we have 2 years of comparatives. If this comes in 2027, that means we need to do this in 2025, which is coming just around the corner. Can you maybe think about providing an exemption? And I don't know if you want to chip in there, Nick, if there was anything else to that discussion.
I mean, I think you've talked through exactly the debate that had happened. I mean, this was also the other side of the argument was a very strong push from investors saying, we want this information as soon as possible. We don't think that the changes that companies need to make are that onerous. We think they should be able to do this in a fairly timely manner. 2027 seems a very long way away. But I think, as you said, the other side of this is why we ended up with 2027 as the effective date for exactly the reasons you've said. And I mean, I think it's worth highlighting every time to get started early. It does sound easy, a few categories, a couple of subtotals, job done, but there are lots of things to think about. And we heard, even if it's just a matter of pulling apart the chart of accounts a little bit and reclassifying things, this can be a really big exercise for some companies. It's going to entail some amount of systems change. And you say, then we're getting into thinking about the controls and just how you're communicating internally and externally with new subtotals. How are we going to get our investors to understand the change from what we used to report to what we report now? All of that's going to take a bit of time and thinking about.
Yeah, and then obviously we need audits. We need a little bit of time to audit those change in processes, systems, and numbers as well. So I think we will probably be more on the stakeholders of saying, give us a little bit more time when you got that feedback. I think one of the points to just make there is just to highlight to folks again. Maybe I'm sounding negative here. I think it's good. It's still it's a positive messaging, but in terms of the transition and the change, I think there's another requirement that says, and by the way, you need to bridge the gap for me so that I can see. I imagine that came from investors as well. What did I used to see under IS1? Do almost like a mini reconsider, not quite as bad as when we applied IFRS 1 for the first time, but what did I used to see from an IS1 perspective to bridge the gap to what I'm going to see from an IFRS 18 perspective? And I think even that type of mapping process is going to take companies a bit of time to kind of get through. So I think that shouldn't be underestimated as well in terms of just your transition disclosures are going to be quite voluminous to get through.
One last question I had actually, Nick, was for some of the more specialist standards that came out previously or more industry-focused ones, there were transition resource groups. IFRS 18 is obviously a bit more pervasive. Is the board planning a transition resource group for application questions?
At this stage, the board has decided that it's not necessary to have a transition resource group. As we've talked about, the majority of the challenge, we think, is more about getting those systems in place, thinking through the company's specific and individual impacts. We think there's sufficient guidance there to give people direction into how to get to the answer. It's more about then going through those mechanics. And we think that that's probably better done through other resources.
That makes sense. All right. So with that then, I might just end with, I might be able to guess each of yours. I won't. But from each of you, what would be your top tip for companies as they are now diving into this?
Can I go first? Because otherwise Nick's going to steal. Because you already said it before again, and every time, Laura, when I've been on these in the past, it's the same. It's unfortunately the same message. So apologies if I sound like a broken record, but it would just be, don't underestimate the amount of work that may be required to go through this. Similar to any standard, it may be that at the end of the day, a massive amount doesn't change, but that doesn't mean that there's not going to be a huge amount of effort that you're going to need to go through to say, these are new requirements. It's not an amendment to IS1, it's a brand new standard. I think the earlier you start and the more there's a good project plan around it and the way you can address it in a measured way, I think the better the outcome will be and the less stressful it'll be for everyone, including us poor auditors. So my suggestion would be, please start as soon as possible.
Yeah, you're right. All I can do is echo that because I think that's the message. We've said a number of times that there's a real danger of underestimating. The effective date is 2027 for a reason, and people should take advantage of that time to really think through. And I think, as you said, have a fresh look at what you're doing today as that disaggregation guidance. We have management defined performance measures to give more company specific information. And there's those changes to subtotals. So all of that gives a good opportunity to rethink and get the best performance reporting that they can.
I think that's a perfect place to leave the podcast. So all of the guidance mentioned today, including the PwC In brief and the implementation page of the IASB, including all the stuff that Nick mentioned, will be linked on our viewpoint page that accompanies the podcast. Thank you, Nick, for joining us. Thank you, Gary, for coming along. And thank you to our listeners. As always, remember to subscribe wherever you get your podcasts. And until next time, happy accounting.
This podcast has been brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitution for consultation with professional advisors.